Welcome back to Wall Street Week. We're joined by Bob Dahl and Troy Gayeski. People want ideas. They're watching right now. They say, I want you two to make me money. You two have found ways to do it in both good markets and bad. Bob, what are your best ideas?
So as a U.S. equity guy, that's my expertise, so you know I'm going to answer that question that way. Free cash flow is king. We're in a slow growth world. Companies that have free cash flow can reinvest in their business. They can hire a worker. They can buy back stock. They can raise dividends. Without it, I got one hand tied behind my back. That's idea number one from a theme standpoint. Number two, I want companies that are generating unit growth. Pricing power, tough to come by in a slow growth world. Finally, geography. Focus on companies that get most of their earnings growth here in the U.S. U.S. economic and earnings growth has been mediocre, but the rest of the world's been worse than mediocre. We're the best house in a bad neighborhood. They're the three themes I'd start with.
How do viewers know? They hear this, free cash flow, but they're not accountants. So how do they know what is a company that generates free cash?
Yeah, you got to do a little work, as you know, Gary. You got to dig in to look at the income statement and add back depreciation, some of the basic things to give you free cash flow, and there are services that do that.
And so the sectors that generate free cash that you're looking at right now are what?
Number one, with no close second, is technology. Big time free cash flow.
You don't think the run-up's been too strong already and that we're at the end of this?
Might they pull back, Liz? Absolutely, but I think it's a long way to go. These stocks are not expensive. I prefer, older, cheaper technology to new. Apple Computer, if I can call that an old tech company, Qualcomm, Cisco. These are the names that I think still have some firepower.
The fact that you're calling it Apple Computer means it's all
yeah, exactly.
Exactly.
And Troy, obviously, in your role at SkyBridge, you're looking at the funds, you're looking at areas that the hedge funds are investing in. It's been a difficult year for hedge funds, but you're finding some opportunities, and where you're looking.
Yeah, and I like what Bob said about free cash flow, because we also think cash flow is king. The difference is what we're investing in are assets that are backed by the housing market or the commercial real estate market. And in that case, what you've seen is very strong fundamentals, particularly for residential housing, yet very high yields. And you can't, cash flows don't lie. So as long as the housing market doesn't collapse, commercial real estate doesn't collapse, you're going to earn those yields and get price upside as we think the technical picture clarifies itself. And one thing we talk about quite a bit is what's driven this inefficiency is the massive regulatory reform on Wall Street due to Dodd-Frank and Basel III. That's basically booted banks out of the business. There's all sorts of complex rules that are going to make it harder for them to own these securities. Hedge funds are stepping in and helping provide financing to the broader economy and giving investors attractive returns.
Can I just push you on asking whether you go for REITs, for example, real estate investment trusts that are focused on commercial because they have long leases that can be counted upon, or residential?
Yeah, so, commercial has more upside right now, given where the prices are and also operating income growth. The problem with REITs as we speak today, though, is they're back on the more expensive end of the range. 2-3 months ago, they were much cheaper. It is a way for a retail investor to play the same theme.
Explain why it's been so difficult, and what does that mean going forward in terms of where the opportunities are, and how can they read through that to say, okay, the smartest guys are going to be the smartest guys again, because they certainly haven't been.
Well, I'll tell you, the biggest problem recently has been the unwind of the event space, mainly due to the debacle in healthcare tied to certain names like Valiant. That caused a lot of pain for the hedge fund industry last year. But since the crisis, the bigger issue has been anything you've shorted has been a disaster. I mean, think about how much treasuries are up. If you didn't like rates, you've lost money shorting treasuries. Think about how much the stock market's up. And when the stock market's up over 200%, you're not going to make money on shorts. So it's been a very challenging environment there. Furthermore, due to central bank policy, we talked about this before, hyper loose monetary policy, never-ending QE, you've had much higher correlations between securities, which makes it harder to add alpha, and it's been challenging for all active managers.
Well, that goes back to you, Bob, because you like equities. Wall Street is littered with people who over the past, well, since 2009 have said, we're going to crash again, we're going to crash again, and their bets have been the wrong way.
This is the least believed bull market of our careers. The amount of, yes, negativism in cash, but it's really uncertainty. People just don't know what to do. And as a result, cash is just accumulated. When I go to retail brokerage offices, and I'll often ask, what's the cash level in this office? 22, 26. I got a 32 recently. There's cash everywhere. I don't think we have a recession coming anytime soon, so maybe stocks don't go up, but I don't see big downside either. So massive amounts of cash.
But Bob, a lot of that is the scars of 2008, even though it's now...
And 2000.
You know, exactly. The last 17 years is fresh in a lot of people's minds. So if somebody's watching right now and they're sitting with 35% cash, they're one of those clients, and they say to you, you know what, I've got to do something. What do you say to them to give them the confidence to be a long-term investor?
The beauty of this business is not black and white, it's gray. So let's get that 35 down to 30. Take 1% of the cash in each of the next 5 months and put it in the equity market. You know, pick your favorite wherever you want to be inside the equity market, and you got a little more invested, but you still have a very conservative portfolio.
And the one thing I'd add is, remember, this show's all about how to create and preserve wealth. And one of the biggest questions for investors right now is how do you make 10, 20%, let's say the next several years.
Good luck.
Before that next recession.
Yes,
Not that you can do that, but the goal is to make 10 to 20%, say the next 2 to 3 years, and then protect capital in that next bear market. And our point, back to your question, Gary, is there are now inefficiencies in markets that weren't here even a year ago, mainly due to regulatory reform, and that gives people a chance to make a reasonable return without getting demolished in the next bear market, which we all know stocks are going to get hammered. What are they going to be down, 30, 40? What do you think, Bob?
It's definitely, if we have, when we have the next recession, sure, we're going to go down a bunch. It happens every time.
Yeah, listen, we've all seen lots of recessions, and unfortunately, we'll see more. Troy Gayeski, Bob Dahl, great to have both of you. Thank you so much. More Wall Street Week straight ahead.